So, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is February the 25th, 10:30 a.m. in the United Arab Emirates, where we are based, very early in other places and later in the East and early in the West. And we thank everybody for joining us. Brent crude oil trading this morning again at $71 and a change. It sort of seems it's found its ceiling, if you like. It's done its $10 geopolitical risk premium over the last few weeks on all the noise about Iran. Big pep rally last night in Washington with Donald Trump, State of the Union speech, a lot of rah rah, the usual talking points. Let's start off here in the Gulf this morning and get some views from James Lear, International Relations Manager at Gulf Mercantile Exchange. James, thinking about this $10 pop up in the oil price over the last few weeks on the sort of growing uncertainty, concern about Iran, seems to have reached a pause. My question to you, has it sufficiently priced in what's at risk here? The objective of these mounting military presence in the region have not really been declared. And so the market seems to be pricing in the least disruptive outcome, i.e., $10, only a few dollars, rather than what seems to be, as I would say, looks like a duck, walks like a duck. This is a regime change built up armada, and the oil markets don't seem to be recognizing that. Your thoughts on the $10 so far? Does it adequately represent what you're perceiving as the risk?
Morning, Sean. Cautiously elevated, I think the price is at the moment. I know you said $10 there. I'm not quite sure. I think it's less than that. I think it's about a $5 premium in at the moment, and I think it would have been $5 up anyway through demand. Yeah, I said it last time I was on. The traders are looking at rumor against fact, and the rumors are the escalation here, but that's not being priced in. I mean, there is a real feeling that from the traders I spoke to recently, it seemed that when the Americans put this idea together, this fleet together, the Armada, as Trump calls it, a lot can change in the 2 weeks before it arrived. And by the time it arrived, the momentum had changed and the whole situation domestically in Iran had changed. So we're now at a station where I think the traders are thinking, well, not much is going to happen. We're all hopeful that's the case. I think it's priced in that there may be some action, some airstrikes, or some limited military exercise, but nothing that's going to disrupt supply. At the end of it, I mean, that's the reason why I think anything more than $10 is overestimating the rumor. Look, there has been no disruption to the supply, and that is the fact. And while that fact remains, these prices will not escalate. Now, if the rumor becomes a fact, then we are talking differences. But I guess all eyes are going to be on tomorrow and in Geneva peace talks. But you're right. I mean, the market. I mean, the markets are in backwardation. Goldman Sachs have said it's probably $64 average over the year, which again points to a de-escalation of problems from here on in. I'm kind of interested. I saw yesterday in the last couple of days that the flow of trading is particularly high, as if the market is just getting on with business. I noticed that the Brent Oman spread, which is something I keep my eye on, for example, traded 2.5 million barrels in under 8 minutes in the last 2 days. So it just, even under these kind of circumstances, when the traders hit what they see as a value sweet spot, they're all in. And when traders are all in, you kind of thinking they don't think there's an awful lot of risk here, which may be misplaced, but that's the way it seems in the market at the moment.
Well, let's go to the center of the market world. Mita Chaturvedi, research associate at Flux Markets. Mita, of course, tracks the crude oil and energy oil products market in London, from London. Mita, what are you seeing in the trends, the flows, as James just referred to there? Is this business as usual in the oil markets, despite all the noisy headlines?
Um, So I think there's two parts to this. There's definitely a risk premium. It's not necessarily strictly like there is this tail end risk that is somewhat being priced in. We're seeing that with options. We're seeing that we're just generally with positioning, with Brent being above $70 generally, that does reflect this geopolitical risk premium. I've been looking at CTA positioning in Brent specifically, and that's significantly higher right now than it was during the 12-day war in 2025. We're talking around 30,000 lots in on the 24th of Feb versus negative during like right before like on the 13th of June 2025. So we're significantly longer than we would have been. Like there is some pricing over there. We are already somewhat positioned, but as James said, I think considering how long we already are in the market, there needs to be a lot more meaningful disruption to supply for us to go beyond this. The bull case over here is that in the event of such a tail end bullish shock, let's say, the absolute end of that would be the Strait of Hormuz being shut, it's complete disruption of supply. CFTC COD data still shows speculative long-short ratio, this speculative long-to-short ratio in Brent futures at around the 34th percentile for all weeks. Since 2013, there's still a significant short position that's built up over here, which could spur short covering. And we could still see longs rise. We could still see prices blow up. But just considering net long positioning right now being at its highest level since April of 2025, it just reinforces how much heavy lifting the current risk premium is doing to keep prices elevated. Sure, there are other elements as well. Freight's really expensive. But right now, I think just in the futures context, a lot of this work is being done by geopolitics, and it really stresses the downside of things once these eases. A lot of focus will therefore be on the Thursday meeting, considering, I mean, Trump's just delivered an hour-long, 48 minutes State of the Union speech with such a little mention of what he intends to do in Iran. So a lot of that focus is still very much fixated on the Thursday meeting in Geneva. And it's especially with that being just ahead of the weekend when we know a lot of these developments tend to happen. It'll be interesting to see how much this sizable long position shifts in the next week, basically.
Let's go to China, where Victor Yang, senior analyst at JLC, is based. Victor, it seems to me that China is the only one really paying attention here. This idea of business as usual kind of reminds me of Ukraine 4 years ago when the Russians built up what was the largest ground armada of military hardware and soldiers since I think the Second World War at the time, in Europe at least. And everybody was going, oh, yeah, it's just kind of war games and posturing and but, if it walks like a duck, it looks like a duck. The US have built up the biggest naval armada since the Iraq War in 2003. It seems to me China is taking that very seriously and consequently has been buying as much oil as they can for the last 12 months and more. Is that continuing?
Well, we would say it can still buy more crude than it consumes, but probably slow down a little bit because of the large stock building over the past, not just past 12 months, but we can also say over the past couple years. And now prices have gone up a little bit too. And for China, industrial activity is still slow at the moment. So we returned to work yesterday, but a lot of factories are still shut down. And they are not going to be back to on stream in a couple of days yet.
Because of the China New Year.
Yeah, the Chinese New Year. It's not,
holidays.
Well, yes, officially it's just 9 days, but factories are shut much longer than that. So we're still seeing much slower industrial activity until early next month, early March. And for China, consumption is just average at the moment, and oil consumption has been kind of stabilized at the moment. And during the holiday, refineries maintain largely stable operation too. And some of them may not be able to build up stockpiles as they used to. Yes, as you know. And because of the price and some other issues and not so strong demand for fuel too. So we expect the stock building to slow down in 2026.
James, looking at the sort of the idea there, some China slowdown in buying for storage, perhaps in 2026, hard to beat last year, given some sort of calculations that China built over 1 million, 1.5 million barrels a day into storage last year. And so for it to decline in 2026 may not tell us a lot given the scale of the build last year. But I'm wondering, are you seeing anything in how this Iran developments, fresh Russia sanctions are changing how China mentioned there, India as well, approach to Middle Eastern crude now that the sanctions on Iran and Russia start to look a little bit more complicated? Can we see any shift in the trading patterns?
Yeah, I mean, from the exchange point of view, we've seen some really big open interest delivery cycles in January and going to be repeated in February, and that usually points to high demand from China and India. So it seems to me that we talk about. I heard someone say the other day that you can't include the Chinese stockpiling as part of demand. Well, it is part of demand as far as I'm concerned. They could be stockpiling for a long time to come, and they, in fact, are increasing their storage capacity. So that's all part of the demand, and we're certainly seeing it from the exchange here. It seems like Russian oil is going to be cheaper with the sanctions that are now affecting India. And it seems that the Chinese are going to buy the Chinese are going to do what they always do, is going to buy as much cheap oil as they possibly can. And it's going at a real cheap rate at the moment from the Urals, that's for sure. So I can't see them letting up on that. It seems they've also, the core supplies coming from the Middle East. That's clearly continuing. We see that the teapots, independent refineries in China tend to veer towards the sanctioned oil of Russia, whilst the government-backed refineries tend to concentrate on the Middle East. As I say, certainly Oman is in demand. Looking at India, which is quite an interesting. I mean, they've cut their Russian oil supplies to their refineries by about 50% this year, concentrating on greater supply from the Middle East. We've also seen them importing quite a bit from Venezuela, presumably to blend with, say, Murban to create a synthetic Urals. It's all a lot more complicated for India than it was, a year ago when they go direct to source and import the Urals from Russia. Ironically enough, the increase that they are now putting on their Middle East supply would actually leave them quite vulnerable to any disruption on the Straits of Hormuz, which kind of would leave, if this escalates, would leave the Indians a bit snookered, and it's not them as being sanctioned, but interesting nonetheless.
Mita, we're all quite focused on the front month, on the Brent front month, and clearly, as we've articulated, it has been reflecting the growing concerns about the Iran-US face-off. But what is the gasoline complex and products complex telling us? Is there another story there? It seemed last month these were sort of two different stories. I know Flux Insights delivers a weekly technical analysis report around these subjects. How do you see the gap between these two stories, if indeed you still see that?
For sure. I think before we get to gasoline, even in
Please.
the crude complexes, even in crude itself, while the futures are seeing this premium, and like we are seeing prices remain fairly supported above 70. Dated Brent, just physical dated Brent, has taken a bit of a beating this week. We've seen prices sell off pretty significantly, especially in the March region when it comes to the weekly CFD rolls. And that weakness in dated Brent is again reflective of seasonally this time of the year, we're beginning to see refinery maintenance. Generally, within dated, high freight has kept West African crudes on a significant, like there has been this supply overhang when it comes to Mediterranean and West African crude, which has also deflated the Dated Brent complex. So a lot of that has been there's been a significant there's been this weird dislocation between the usually positive correlation that we see between Brent spreads and dated spreads. It's still weakly positive, but well below historical levels. Like that correlation has significantly broken down this past 2 weeks. And that's something really interesting. And again, and that sets the course for the products as well. We have seen gasoline in the front being fairly weak. Naphtha has also been fairly weak. The crude, naphtha has been a product of crude being really strong as well, and which has pressured naphtha cracks. But just at these levels, just positioning wise, we are still seeing buy side interest around the Q3 region for gasoline cracks. There seems to be this indication that people might want to continue to buy cheaper cracks in the summertime region when demand tends to be a lot better due to the US and driving season in the summer. But right now, just looking at the front months, there seems to be this bearish pressure engulfing through products. We're seeing this in high sulfur fuel oil as well, where Sing 380 was fairly supported just a week ago, but then this week began with a sell-off again. I don't know if a part of that could be financial positioning driven, with people perhaps taking profit, understanding the risks ahead with so much with all the uncertainty geopolitically and with respect to freight, but. Again, with high sulfur fuel oil, we are seeing some support in the summer. So I think to me, it seems that there's just a lot more uncertainty in the front. And we're seeing a lot more people opting to take their positions to further deferred, assuming that there'll be this easing of the risk premium by the third quarter or the fourth quarter of the year, when they could maybe go back to fundamentals. A lot of traders have been telling me that this is not a market they're used to in terms of the dislocation between fundamentals and what's happening with the futures right now. And that's making trading in the front all the more murkier.
They're having to earn their living now as compared to the free lunches they've had for a while. Victor, looking at the situation from China's perspective here, we're seeing this obviously developments in Iran, this buildup of the Armada, the U.S. Naval Armada, which, as we said, by most records is regarded as the biggest since 20 odd years ago when we had the U.S. Iraq war. And it replicates what the Americans did in Venezuela a few weeks ago, built up a huge armada, put a big squeeze on. Eventually ended up not doing very much other than arresting 2 people, the president and his wife, but ultimately did the big hijack. They essentially stole, if that's the word, captured, control now Venezuela's oil industry. They've got it by the... Now, one could see that being as the potential outcome here. Whatever happens, the Iranian oil industry ends up in the hands of Donald Trump. What would that mean for China, who has been relying heavily, a lot on not only cheap Iranian oil, but the Iranian oil complex? Can it replace that? What are your thoughts from a China perspective on these developments geopolitically, as well as just from a basic supply point of view? Can Venezuela and Iran be replaced in the complex of Iranian oil or Chinese oil imports?
Well, first, when we look at the supply from Venezuela first, well, independent refiners have stopped the imports of such crude because of the U.S. interception, well, you would say hijack. And now, when it comes to Iran, if it falls into the hand of the U.S. again, this could happen again, particularly with independent refiners, because they rely a lot on relatively cheap cargoes. But for the country, they can step up imports from the Middle East and other suppliers to make up for the loss. And another important reason is that it can will turn to the stockpile it has built over the past few years for a short period of time before it can find some alternatives too. So we do not see that as a very big issue for the moment.
The idea that this collective strategy, if indeed this control of oil flows from these, not only Venezuela, but also Iran, and with that Iran, one says one controls the whole oil flow out of the Gulf here, which is, you know, quite a significant number, up to 20 million barrels a day. Is the perception in, or how does China perceive this? As we said earlier, the Americans haven't clearly declared what their intention is, why they are doing this. And a lot of voices in America asking for the Trump administration to clearly give their why they are seeing this urgent reason to attack Iran. They've said, you know, nuclear, this and that, but of course, only a few months ago, they said the nuclear industry was destroyed. From a China perspective, how is this being reviewed? How is it being reported in the newspapers, on the televisions in China? What's the narrative there as to why this is happening?
Well, when we look at what the US does in the world, sometimes, well, it's because of their, say, first, because of the oil. And some other reason is because of other interests, because of the power. Say, for instance, when one country, particularly such as the US, is finding that it has too much trouble in the domestic market, it turns to other countries to kind of shift the attention, the focus too. And when we look at Venezuela, for instance, a lot would say this is because of oil, and oil is just one of the reasons for the actions of the US, I would say. And some of the reasons because of the attempt to consolidate its power in some countries, some regions too, such as in South America. And it's kind of, you can also look at it this way, as a kind of attempt to consolidate its power in some front against China too, and not only for its own interest, such as revenue from oil too. So for China, the biggest is going to be, it needs to diversify its supply further from other countries. And as you know, China does not allies, I mean military allies or whatever. It just trades with other countries. So long as you are trading with China, well, fairly, it trades with you, regardless of the political system or whatever. No strings attached. So this is an advantage, but also a disadvantage too. So if a country is hijacked, is bullied by another country, say by the US, it's not going to say, oh, well, so long as you trade with me, I will protect you, I will send troops over. So there's a different story. You can also regard it as a disadvantage, but that's the way China does its business. It trades all over the world. What is willing to trade with us, we'll do business with you. We do not talk about the political agenda, whatever. Yeah, that's the.
Okay, let's go to the survey question here, which is obviously sort of tackling this basic point. My little favorite phrase for today: if it looks like a duck and walks like a duck, oil markets should price in Trump's objective for Iran is regime change. The idea that we are seeing the buildup of such a huge military might here. It's much, it would appear much greater than threat or leverage in the context of a negotiation in Geneva. This is the scale in which wars are conducted. At least that's what they've done in the past. Now, we can all convince ourselves that these are different times and Trump is different and all of these things. But ultimately, a bit like Russia on Ukraine's border 4 years ago, US on Iran's border now, oil markets don't seem to be, because regime change is the context of existential threat to the government in Iran. The reaction is what is the critical piece here. If Iran sees this as just a kind of another one of those moments where they get a slap and life goes on, if they perceive it as a regime change intention, the reaction is the critical piece here. We know what the Americans could do, that's very clear. The reaction is what it's all about. And if the Iranians perceive this as existential threat to their existence, then of course the reaction is very different. And that to me is not priced in to the oil markets in any way. The lowest consequence seems to be priced in. In the middle of all this, James, as we try to wrap up here, OPEC Plus have to meet in a few days and make sense of the world for the second quarter after they've paused their supply increases through most of 2025. The first quarter this year, they decided, okay, let's hold here. But a lot of predictions, including from Kepler and others, that they will start again to increase into the second quarter. Your thoughts of what OPEC Plus is facing in this decision they have to make now?
Well, it's interesting. I mean, the last meeting they had, there was a lot of talk about denying the oversupply question. I think that continues, Sean. I don't think they believe in oversupply at the moment. I think they think there's enough demand, and I think the messages coming out of China and India is that there is enough demand, and that will determine the language they use, I think, in this session. I mean, and coming back to what are we going to see tomorrow? I mean, the peace talks. Obviously, I remain optimistic. I think the traders here are optimistic, but you never know with the Americans, right? So it comes down to paraphrase old Maslow, wasn't it? If you've got a big military hammer, every problem begins to look like a nail. But a lot of these nails are tougher than others. So I really hope this is all de-escalated, and we'll see what OPEC Plus have to say next week.
Well, of course, it's all very immediately relevant to us because, we literally sit across the water from all of this, and one never wants to see it anywhere in the world, but certainly not on your doorstep. Mita, looking out into the wider markets here, oil at $70, well, $60 a few weeks ago was obviously dirt cheap. At $70, given where gold and other commodities are we seeing any notable flow to the long side into oil? The sort of Wall Street hedge funds, mutual funds pouring in as they've poured into every other commodity. Does oil now get its turn in the limelight?
I haven't heard of a specific fund talking about oil the way they were talking about copper a couple of years ago. There hasn't been that trade that has stood out to me necessarily, but just again, looking at fund positioning, there has been a rise in fund positioning into oil. And that's also, again, talking about the disconnect between the physical dated Brent versus Brent crude futures. So there definitely is a lot more on the speculative fund side in Brent right now that we're seeing that is keeping up prices. That's about it on the fund side. I think it'll be interesting. I completely agree with what you said that this isn't, we haven't priced in a tail end bullish shock yet, but it's one of those things where a lot of traders tell me that they are, because of how disconnected the physical crude picture is right now, unless we see something in the next few days, in the next week, in terms of what the US's plans are with Iran, what is going to happen. It just feels like the longer nothing happens, the longer it feels like nothing is going to happen. And the dislocation between Brent futures and dated Brent might not necessarily be that sustainable in the next few weeks, in the next month, for instance. So something has to give. Either dated has to rapidly rise, and in this current trade environment, we're not sure if that might necessarily be the case. So if nothing happens on the geopolitical front, and nothing happens with what the US plans to do with Iran, looks like Brent might be the domino that falls instead.
Well, it returns to its cruising altitude of 60, 65 rather than above 70. Victor, at these prices, regardless of all the noise of the politics, China doesn't like to buy too much crude oil. It doesn't need above $70 a barrel. Is this still a price-sensitive buying exercise in China? This excess crude for storage, yes, it's for national security purposes, but at the right price rather than at any price.
Well, I think this price is already a bit high for the country to buy larger volumes. Well, it will probably wait for some time and to see whether it needs to step up purchase or not, because at the moment it doesn't need to do so.
But it does still has storage capacity. If indeed it wanted to buy excess oil, it has places to put it.
Well, a little bit more extra capacity, I think, because the country built some stock tanks last year and it's still building some others. So we still see some extra capacity for stock building, but not as much as previously.
At our round table in London a few weeks ago, with Mita was there was a comment at the table that said China was building 100 million barrels of new storage capacity this year. Is that anywhere near true that you're aware of?
100 million barrels, you mean this year?
Yes.
100
Extra.
million
Extra of
100
storage capacity above ground tanks.
It seems a bit larger than the capacity I know of. I need to check because from the number I see, it's not that large. It's not that large.
Everybody sort of gasped at the number, but nonetheless, everything in China is bigger, like Australia for different other reasons. But that's another story. James Lear at GME in Dubai, thank you so much. Mita Chakravarty, thank you for joining us for the first time. Please come back again. And Victor Yang, one of our regulars, anchor commentator from China Energy. Thank you so much, Victor Yang at JLC. All the best. Have a great day, everybody. And let's hope for the best in Geneva tomorrow.
Thanks, Sean.
Bye-bye. Thank you.
Yes.
Bye, everyone.
Bye-bye.
Thank you.
Bye, everyone.
Bye-bye, everyone. James, Mita, bye-bye.